Welcome students. I'm Dr. Murugesan, Associate Professor, Wales Institute of Science, Technology and Advanced Studies, Pallavaram, Chennai. So today we are going to discuss about the profit prior to incorporation from Corporate Accounting 1, Lab 2, Unit 8. Profit prior to incorporation. What is profit prior to incorporation? Introduction. A company may acquire another business from a date prior to its incorporation, normally from being the business uh, of the accounting year of selling concern with a view to avoid preparation of final accounts of the date of acquisition or purchase the business. So due to they will prepare profit prior to incorporation. That means how much they earned before incorporation and after incorporation. For the purpose, they prepare profit prior to incorporation. For example, a company incorporated on 1st April 2010 may purchase a business with effect from 1st January 2010, a date on which the accounting year of the vendor starts. Suppose a company closes its accounts on 31st December 2010 and prepare profit and loss account for the year ended 31st December 2010. That means any profit earned by the company from 1/1/2010 to 1/4/2010 is known as profit prior to incorporation and treated as capital profit and transferred to capital reserve account. In the same manner, the loss incurred profit prior to incorporation is treated as capital loss and debited to goodwill account. All the profits earned by the company after the date of its incorporation, that means from 1/4/2010 to the closing date 31/12/2010, this profit is called as revenue profit and transferred to profit and loss account. In case loss means that also transferred to profit and loss account debit side. Right? This is the major important part in profit prior to incorporation. That means the company started one date, they incorporated or getting the incorporation certificate in the middle of the year or any date in between the year, and at the end of the year they may be closing their accounts. So from the opening date, that means purchase date, purchase of business date to the incorporation date, then the incorporation date to the closing date. So from the purchasing date to incorporation date, that profit earned by the company is called as capital profit or profit prior to incorporation. After the registration of the company, the earning the profit is called as post incorporation profit or revenue profit. So profit prior to incorporation or pre-incorporation profit or capital profit. So profit earned by the company before or up to the incorporation date, it is called as capital profit or pre-incorporation profit or profit prior to incorporation. Then the second profit is post-incorporation profit or revenue profit. So all the profits earned by the company after its incorporation is called as revenue profit or post incorporation profit. The next most important stage is basis of apportionment of expenses and income of the company or the business. We have four classifications. Based on the four classifications, we should apportionment made to the expenses and income. So first one is time ratio, second one is sales ratio, third one is adjusted or weighted time ratio, then fourth one is weighted sales ratio. If we have any adjustment regarding to time as well as sales, we will use it the last two, adjusted or weighted time ratio or weighted sales ratio. Otherwise, we should use only for time ratio and sales ratio. Some expenses allocated based on the pre-incorporation period, some expenses allocated based on the post-incorporation period. What is time ratio? This is the ratio of month or days before and after incorporation of the during the accounting period. Time ratio equal to period up to or before incorporation is to period after incorporation. For example, date of purchase of the business is 1/1/2009. The date of incorporation 1/5/2009. The date of closing of accounts 31/12/2009. That means from 1/1/2009 to 1/5/2009. It includes 4 months. Then after incorporation, that means 1/5/2009 to 31/12/2009, it includes 8 months. That means the time ratio is 4 months is to 8 months. So time ratio equal to period up to incorporation is to period after incorporation. So 1/1/2009 to 1/5/2009 is to 1/5/2009 to 31/12/2009. So 4 months is to 8 months. That means the ratio is 1 is to 2. Right? So 4 is to 8, it converted into 1 is to 2. Then the next ratio is sales ratio. This is the ratio of sales or turnover of the company before and after incorporation. Sales ratio equal sales up to or before incorporation is to sales after incorporation. For example, total sales of the company for the year rupees 6 lakhs. Sales up to incorporation is rupees 2 lakhs. So how to calculate the sales ratio? So as per the formula, sales up to incorporation or before incorporation is to sales after incorporation. So there have been two sales. One is total sales, another one is sales up to incorporation. So as per sales ratio formula, sales up to incorporation is to sales after incorporation. So they have given directly sales up to incorporation is rupees 2 lakhs is to we should find out for how much sales made for post incorporation. That means total sales minus sales up to incorporation. So 6 lakhs minus 2 lakhs. The remaining value is 4 lakhs. That means the ratio is 2 is to 1. Then adjusted or weighted time ratio. If any changes were made in the number of employees or office accommodation, weight must be given to the changes in arriving at the time ratio. Such a ratio is called as weighted or adjusted time ratio. If in case a company already working for 50 employees, if it may be they may be increasing their employees position is 50 to 75. That means we need to calculate adjusted time ratio or weighted time ratio. So based on the duration, for example, the first 4 months of the year is 50 employees working. The second balance 8 months the employee working is 75. That means we must calculate adjusted time ratio. Looks like for weighted sales ratio. If sales were not uniformed throughout the accounting period, weightage must be given to the trend observed in the sales. Sales ratio adjusted for the change in the trend is called as weighted sales ratio. So depending upon the increasing and decreasing of sales, we must use it for weighted sales ratio, right? The following items are allocated on the basis of time ratio. So what are all the expenses allocated on the basis of time ratio? Rent and rates, insurance premium, salaries, printing and stationery, postage and telegrams, repairs and maintenance, interest charges, depreciation, general expenses, office and administration expenses, management expenses, income tax, interest on loan, electricity charges, bank charges, audit fees. These are all the expenses comes under the category of allocated on the basis of time ratio. So these are all the expenses mostly comes under the category of fixed overheads or fixed expenses. Right? Then followed by the following expenses are allocated on the basis of sales ratio. So what are all the expenses allocated on the basis of sales ratio? So gross profit, then discount, sales commission, brokerage, traveler's salary or travel salary, salesman's salary, advertisement, carriage outwards, bad debts, selling expenses. So all the expenses related to selling and distribution of the products that comes under the category of or allocated under the category of sales ratio. Then the following expenses only taken into post incorporation. The listed or mentioned items are only taken into post incorporation. Donation to political parties, formation expenses, preliminary expenses, directors' fees, debentures, interest. Almost these are all the items which should paid at the end of the year. So it should be taken only for post incorporation as per the norms. These are all the expenses taken only for post-incorporation periods. Next category, the following items only taken into pre-incorporation period. So the listed items taken into pre-incorporation durations only. So interest on capital, partner's salary, bad debts realized. So these three items are posted on pre-incorporation only, right? So this is the format. So statement of profit prior to incorporation. It's a statement format. So particulars, then followed by basis, then ratio, the total amount, then pre-incorporation, post-incorporation. So the top we must take it for gross profit. So under what basis it should be allocated? Sales ratio. So the ratio, for example, 2 is to 1 or 3 is to 1 like this, we should mention. Then the total amount split into as per ratio. For example, 15,000, the ratio is 2 is to 1. So 10,000, 5,000 likewise. Then add incomes and gains. Commission received, sales ratio. Rent received, time ratio. So depending upon the information provided in that problem, we should take. So and also allocated based on the ratios. Then followed by less expenses and the losses. For example, rent and rates, time ratio, commission, sales ratio, salaries, time ratio, discount, sales ratio, interest on capital, pre-incorporation, debenture interest, pre-incorporation. So based on that, we should deduct and allocate all the expenses divided into pre-incorporation period and post-incorporation period. Then after we will get from the total incomes and deduct expenses means we will get net profit. Looks like for pre-incorporation profit and post-incorporation profit, we will get pre-incorporation profit and post-incorporation profit. Right? This is the statement. Now we will move to problem number 1. First we will start basic problems and then move to uh, statement problems, right? So problem number 1. Ganesh Limited was incorporated on 1st May 1996 to purchase a running business of Vinayak and Company with effect from 1st January 1996. The company obtained the certificate of commencement of business on 24th August 1996. Calculate time ratio if the accounts are finalized on 31st December 1996. So when it was incorporated on 1st May, when the company purchased 1st January, the company closed on 31st December 1996. The obtained certificate of commencement is not a matter. The incorporation date is the most important. So incorporation date 1596, opening date 1196, closing date 31/12/96. With the help of these three dates, we will calculate time ratio. So calculation of time ratio. Time ratio equal period up to incorporation is the period after incorporation. So period up to incorporation, that means purchase of business to incorporation date. So 1196 to 1596 is the period after incorporation. So 1596 to 31/12/96. So from 1196 to 1596 we have 4 months. So 4 months is from 1596 to 31/12/96 we have 8 months. So ratio 1:2. That is the answer. Then move to problem number 2. You are required to calculate the time ratio for the pre and post incorporation period from the following particulars. So the date of incorporation 1st June 1999. Period of financial accounts April 1999 to March 2000. Total wages 4,800. Number of workers pre-incorporation period 5, post-incorporation period 25. Also divide the total wages between pre and post-incorporation periods. So in the previous problem they are asking only for time ratio. This time they are asking for time ratio as well as allocation of wages based on the number of employees. That means pre-incorporation period the number of employees is 5, post-incorporation period the number of employees is 25. That means we must calculate adjusted time ratio. That is the difference between the previous and the current problem, right? Now we will go to the answer. So calculation of time ratio. Before that, so the So the date of incorporation 1st June, that means 1/1/16 1999. But the financial accounting period they have given April to March. That means 1/4/2000, sorry, 1999 to 31/12/2000. That is the period. So from 1/4/1999 to 1/6/1999, that duration is taken as pre-incorporation. Then 1/6/1999 to 31/3/2000 is post-incorporation period. So based on that, so period after incorporation is the period after incorporation. So 1/4/1999 to 1/6/1999 is 1/6/1999 to 31/3/2000. So from 1/4/1999 to 1/6/1999, we have only 2 months, April and May. From 1/6/1999 to 31/3/2000, we have 10 months. That means ratio is 1:5. So now we need to calculate adjusted or weighted time ratio. So how to calculate adjusted or weighted time ratio? So based on the previous time ratio, we must use it the number of employees. So the previous time ratio is 1:5. So 1 into the pre-incorporation period number of workers is 5. So 1 into 5 is the incorporation month is ratio is 5 into the number of employees available, that duration is 25. So 1 into 5, 5, 5 into 25, 125. That means the ratio is 1:25. With the help of adjusted time ratio, we should allocate the total wages. So total wages is 4,800. How much for pre-incorporation period? How much for post-incorporation period? So based on the adjusted time ratio, we should allocate. So pre-incorporation equal 4,800 into 1 by 26. That means rupees 185. For post-incorporation period equal 4,800 into 25 by 26. That means we will get rupees 4,615. So this is the method to allocate the wages. The same to be applied for preparation of profit prior to incorporation statement also, right? Then we will move to problem number 3. A company was incorporated on 1st July 1996. To acquire a running business from 1st April 1996, when accounts were finalized on 31st March 1997. The following facts were noted. Sales for the year were rupees 4,80,000. The trends of sales were as under during the specified month. April, July, September, December average sales. May, August, October and February 50% of average sales. So with these informations, we must find out adjusted sales ratio. Okay, you are required to find out the sales ratio for the purpose of ascertaining profit prior to incorporation. So the sales for the year was rupees 4,80,000 on the whole, but the trends of sales is different. They are given in different ways. In for April, July, September, December average sales. Then May, August, October and February 50% of average sales. They have given only 8 months. But in a year we have 12 months. The remaining 4 months how much we should find out. Then based on that we will calculate the sales ratio. Calculation of sales ratio. Sales equal sales after incorporation is to sales after incorporation. So when they will incorporate the sales, likewise we should calculate. Listen, as per the problem. So the incorporation date is 1st July 1996. Opening date is 1st April 1996. Then closing date is 31st March 1997. That means we will taken from 1st April 1996 to 1st July 1996 sales. Then 1st July 1996 sales to 31st March 97 sales. Then only we should calculate sales ratio. Okay, first we should calculate the sales. After that we will work out sales ratio. So first you should list out the sales ratio formula. Sales ratio equal to sales after incorporation is the sales after incorporation. After that we should leave some spaces. Then we comes to working calculation of average sales. Total sales divided by number of months in a year. So total sales given in that problem is 4,80,000. Number of months in a year is 12. So 4,80,000 divided by 12. we will get 40,000. So April, July, September, December, they have given average sales. So sales for April 40,000, July 40,000, September 40,000, December 40,000, totally 1,60,000. Then sales for May, August, October and February, they have given 50% of average sales. So May 40,000 into 50,100, 20,000, like August, October and February. The total sales for this period is equal to 80,000. Then the remaining sales goes for sales for January, March, June and November. These periods are missing in that problem. So the remaining sales for this period, so January, March, June and November. So 4,80,000 minus 1,60,000 for the first 4 months, then 80,000 for the next 4 months, then the remaining sales is rupees 2,40,000. So total sales 4,80,000. Then the previous slide we work out for sales for April, July, September, December 1,60,000. First we should deduct the 1,60,000 from total sales. Then we should deduct this amount from here. Then the remaining sales is 2,40,000. The 2,40,000 for the mentioned month January, March, June and November. So how to calculate for each and every month? The remaining sales 2,40,000 divided by remaining month is 4. So 2,40,000 divided by 4 we will get 60,000 for January, March, June and November. So with the help of these informations we should find out sales ratio. So move to the first slide. So for first April sales 40,000, May sales 20,000, June sales 60,000 is for sales for July 40,000, August 20,000, September 40,000, October 20,000, November 60,000, December 40,000, January 60,000, February 20,000 and March 60,000. So we should adding the sales up to incorporation and sales after incorporation. So up to incorporation period sales is 1,20,000. After incorporation period sales is 3,60,000. We add these two figures, we will get total sales 4,80,000, right? So 1,20,000 is to 3,60,000. The ratio is 1:3. That's it. Right. Then problem number 4. Kalpana Limited was incorporated on 1/4/1992 to take over the business of Nattu Brothers from 1/1/92. From the following information, calculate sales ratio and gross profit. So point number 1, sales during the period January to December 1992 amounted to rupees 72,000. On trends of the sales was as under. January and February, half of average sales in each month. Then May, June, July, average sales in each month. October, average sales. November and December, of the average sales in each month. Then they have given second option, cost of goods sold 18,000. So with the help of these information, they are asking for sales ratio and also calculate gross profit, right? So looks like previous problem. We should work out each and every category of sales. Then with the help of the different months sales, we will find out sales ratio. Then followed by we should calculate gross profit. First calculation of sales ratio. Sales ratio equal sales up to incorporation is to sales after incorporation. Leave it some space. Then calculation of gross profit. Cost of goods sold equal to sales minus gross profit. We know the value of cost of goods sold and sales value. So cost of goods sold 18,000 equal to sales 72,000 minus gross profit. So letters comes to a single side and numbers comes to single side. So gross profit equal 72,000 minus 18,000. So gross profit equal to rupees 54,000 is a simple answer. But how to calculate sales ratio? We will move to next slide. Workings, calculation of average sales. Total sales divided by number of months in a year. Total sales 72,000. Number of months in a year 12. So average sales rupees 6,000. Sales for January, February, November, December half of average sales. So 3,000, 3,000, 3,000 respectively for the mentioned month. So 12,000. Sales for May, June, July, October, it's average sales. So 6,000 respectively for 4 months, 24,000. Then sales for March, April, August and September, the missing month. So total sales minus first 4 month sales minus second 4 month sales, then the remaining 36,000. So 36,000 divided by the remaining months is 4. So average sales for the remaining 4 months is 9,000 rupees. With the help of these values, we should calculate time ratio. So incorporation date 1st April, beginning date 1st January, closing date 31st December. From 1/1 to 1/4, first 3 months. So 3,000, 3,000 plus 9,000 is 9,000 plus 6,000 plus 6,000 plus 6,000 plus 9,000 plus 9,000 plus 6,000 plus 3,000 plus 3,000. So the respective months sales added, then we will get period of sales up to incorporation, sales after incorporation. So first 3 months sales. That means January, February, March. 15,000 is to 57,000. So ratio is 5 is to 19. So we first cut it 3 zeros, 3 zeros in the respective months. Then the 15 and 57 divisible by 1 by 3. Then we will get 5 is to 19. That's the answer for problem number 4. Then problem number 5. Raja Limited was incorporated on 1st 1/7/2002, which took over a running concern with effect from 1/1/2002. The sales for the period up to 1/7/2002 was rupees 2,70,000, and the sales from 1/7/2002 to 31/12/2002 amounted to rupees 3,30,000. So the incorporation date 1/7, opening date 1/1/2002. That means 1/7 to 1st July, 6 months. Then 1st July to 31st December, 6 months. So time ratio 1:1. Then they are given up to incorporation 2,70,000 sales. After incorporation 3,30,000. It's also so simple. So 9 is 11, I think. Right? So then the expenses debited to profit and loss account included director fees 15,000, bad debts 1,800, advertisement rupees 500 per month. So generally advertisement allocated on the basis of sales ratio, but here they are given rupees 500 per month. So based on that we will allocate. Then salaries and general expenses 32,000, preliminary expenses written off rupees 3,000. Gross profit was 1/1/2002 to 31/12/2002 2,40,000 as a net profit prior to incorporation. So the above information, so that means the expenses we should allocate based on that ratios. Okay, right. First, we should calculate time ratio. So, time ratio equal to period after incorporation is to period after incorporation. 1/1/2002 to 1/7/2002 is 1/7/2002 to 31/12/2002. 6 months, 6 months. That means time ratio 1:1. Then calculation of sales ratio. Sales ratio equal sales up to incorporation is to sales after incorporation. So, up to incorporation sales 2,70,000. After incorporation sales 3,30,000. That means the ratio is 9:11. Then the statement of profit prior to incorporation of Raja Limited for 31/12/2002. Then we should open different columns. First column particulars, second column basis, third column ratios, and then fourth column total. It includes two columns, 2 rupees columns. Then followed by pre-incorporation. It includes two columns, and post-incorporation it includes two columns. So allocate the columns properly. Okay, then only we should work out properly for the statement of profit prior to incorporation. So here, for all the problems at the top, we should post gross profit. So gross profit allocated on the basis of sales ratio. So in this problem, sales ratio is 9:11. The total value of gross profit is 2,40,000. It should be posted total column in the outer column, right? 2,40,000. Looks like it's an income category. So the income category of items posted on the outer column, right? So 2,40,000 into 9/20, 1,08,000. Then for post incorporation, 2,40,000 into 11/20, we will get 1,13,000. Then there is no additional incomes or gains. So we will less the expenses. So less expenses First director fees. There is no basis. It's a actual. That means post incorporation period. So 15,000 total. It should be posted in the inner column. So all the expenses posted in the inner column. The respective total pre-incorporation period, the post-incorporation period, right? So director fees is post-incorporation only. So put it nil in pre-incorporation and post amount post-incorporation 15,000. Then bad debts should be allocated on the basis of sales ratio. Sales ratio is 9 is 11, so 1,800. 1,800 into 9 by 20, 810. Then 1,000. 800 into 11 by 20, 990. Advertisement generally allocated on the basis of sales ratio, but in this problem they are given 500 per month. 500 per month. So it includes some mistakes. So not 1,500. Here 500. 500 into 6. Right. Yes, 500 into 6, 3,000. Then again 500 into 6, 3,000. How to multiply with 6? Pre-incorporation duration is 6 months. Post-incorporation duration is 6. So totally 6,000. It should be classified according to the duration of pre-incorporation and post-incorporation. We will get 3,000, 3,000 respectively. Then salaries and general expenses. According to time ratio, it should be allocated. Time ratio is 1 is to 1. The total amount is 32,000 allocated on 1 is to 1 ratio, 16,000, 16,000. Then followed by preliminary expenses. It's also allocated on the basis of only post incorporations. So total amount is 3,000. The 3,000 posted allocated only for post incorporation. You should put it nil on pre-incorporation and post rupees 3,000 in post-incorporation. So add all the expenses in total pre-incorporation and post-incorporation durations. It should be posted on the outer column, the total values. So 15,000 plus 1,800 plus 6,000 plus 32,000 plus 3,000. The total value is 57,800. First, if you deduct the total expenses from gross profit, you will get net profit. So 2,40,000 minus 57,800. The balance is 1,82,100. That is called as net profit. Put the remaining columns nil nil. Then followed by close pre-incorporation columns. So pre-incorporation profit is 1,800. Then we have some expenses. Add these items and post it in the outer column. So 810 plus 3,000 plus 16,000. Total is 19,810. The 19,810 deducted from 1,08,000. The balance is 88,190. That profit is called as pre-incorporation profit. So put it nil in post-incorporation column. Then we should close for post-incorporation columns. So post-incorporation's gross profit is 1,32,000. We have some expenses in post-incorporation inner columns. 15,000 plus 990 plus 3,000 plus 16,000 plus 3,000. We should add these amount and we will get 37,990. It should be deducted from 1,32,000. Then we will get 94,010. This profit is called as post-incorporation profit. That's it. Problem number 6. A company was incorporated on 1st May 2004 to take over the business as going concern from 1st January of the same year. The turnover for the year ended 31st December rupees 2 lakh, namely 60,000 for the first period up to 1st May and rupees 1,40,000 for the following period from and the profit and loss account given below. For the year ended 31st December 2004, you are required to record profit prior to incorporation. So they have given sales for the year 2 lakh, out of which 60,000 for a period up to 1st May, remaining 1,40,000 for the period up to, that means from 1st May to at the end of 31st December, 1,40,000, right? So the incorporation date 1st May, the running business taken over from 1st January. It means 1/1/2004 to 1/5/2004 is to 1/5/2004 to 31/12/2004. That is time ratio duration. Looks sales 60,000 is to 1,40,000 is taken for calculation of sales ratio. It's a simple problem only. So profit and loss account for the year ended 31/12/2004, they have given some information. So on the debit side, they have given rent and rates, insurance, direct fees, light, salary, salary sales commission, sales discount, general expenses, carriage outwards, bank charges, repairs, bad debts, loan interest, net profit. On the opposite side, gross profit 70,000. Both sides given 70,000. So we should allocate the mentioned expenses on their apportion basis. We should work out the problem, right? Right. So first calculation of time ratio. Time ratio equal to period after incorporation is to period after incorporation. 1/1/2004 to 1/5/2004 4 months. 1/5/2004 to 31/12/2004 8 months. So ratio is 1:2. Then calculation of sales ratio. Sales ratio equal sales up to incorporation is to sales after incorporation. So the up to incorporation period sales is 60,000. After incorporation period sales is 1,40,000. So that means ratio is 3:7. Then statement of profit prior to incorporation for the year 31/12/2004. So they are given lots of information. So each and every category we should allocate properly. So particulars, basis, ratio, total 2 rupees columns, pre-incorporation 2 rupees column, post-incorporation 2 rupees columns. At the top, as usual, gross profit, sales ratio 3:7. Total amount is 70,000. The 70,000 allocated on the basis of 3:7, 21,000, 49,000 respectively for pre-incorporation and post-incorporation periods. There is no incomes available, so we will deduct all the expenses from gross profit. Rent and rates on the basis of time ratio. Time ratio is 1:2. The total amount is 3,240. 3,240 is allocated on the basis of 1:2 for pre and post incorporation. So it should be posted in the inner column of respective period. So 1,080, 2,160. Then insurance. It's also allocated on the basis of time ratio. 720, 240, 480. Lighting also allocated on the basis of time ratio. 2040, 680, 1360. Salaries also time ratio. 7,800, 2,600, 5,200 respectively. Director fees should be posted only for post incorporation 2,000, pre incorporation and post incorporation 2,000. Then sales discount, sales ratio 3:7, 5,000, 1,500, 3,500. Sales commission, sales ratio 10,000, so 3,000, 7,000. General expenses based on time ratio 2,400, 800, 1,600. Carriage outwards, it's also allocated on the basis of sales ratio. So 3,900, 2,100. Bank charges time ratio 420, 140, 280. Repairs also time ratio 1,380, 460, 920. Bad debts sales ratio 600, 180, 420. Loan interest, it's also allocated on the basis of time ratio. So 1,200, 400, 800 respectively. Then after adding all the expenses, and it should be deducted from the respective period's profit. So all the total expenses adding it, we will get 39,800, which will be deducted from the 70,000. We will get 30,200. That is called as net profit. Then followed by we will come to end and close pre-incorporation. So pre-incorporation expenses should adding it, and we will get 11,980. It should be deducted from pre-incorporation gross profit 21,000. We will get 9,020. That is called as pre-incorporation profit. Then followed by to close post-incorporation duration period. So post incorporation period expenses we should adding it, we will get 27,820. It should be deducted from post incorporation profit of GP 49,000. So we will get 21,180. That amount is called as post incorporation profit or revenue profit. That's it. So we have one more problem. We have two more problems. Okay, we will work out and discuss. Right? Problem number 7. Right. From the following particulars, ascertain profit prior to and after incorporation. So they are given directly: time ratio, sales ratio, gross profit 10 lakhs, expenses debited to profit and loss account where. So particulars: income credited to profit and loss account where. Okay, so rent received 18,000, interest received 90,000, then followed by expenses, salaries 96,000, general expenses 12,000, discount on sales 40,000, advertisement 50,000, preliminary expenses 70,000, rental rates 65,000, printing and stationery 65,000. Why I should take this problem means, in this problem they are given two income items: rent received and interest received. In the previous problems they are given only expenses and the gross profit, but in this question they are given gross profit as well as some incomes and as well as some expenses. Okay, that's what is it. So first we no need to calculate time ratio and the sales ratio because they are already given in that problem. So we should directly prepare for statement of profit prior to incorporation. So particulars: basis, ratio, total 2 rupees columns, pre-incorporation 2 rupees column, post-incorporation 2 rupees columns, right? So at the top, as usual, gross profit, sales ratio. Sales ratio given in the problem is 4:6. Total amount of gross profit is 10 lakhs. We should allocate based on the ratio of 4:6, 4 lakhs and 6 lakhs respectively for pre-incorporation and post-incorporation. Then add incomes. Rent received. Rent received generally taken as time ratio. Time ratio is given in the problem is 3:5. So total amount is 18,000. It should be posted in the inner column of respective columns. So 18,000 based on allocated on the base of 3:5, 6,750, 11,250. Then we have one more income, interest received. It's also comes allocate on the base of time ratio. So 50,000, 18,750, 31,250. So add these two incomes and it should be added with the gross profit and allocated profit. Then we will get profit. So 10 lakh plus 68,000, 10 lakh 68,000, 4 lakh plus 25,500, 4 lakh 25,500, then 6 lakh plus 42,500, 6 lakh 42,500. That is called as total income. Then followed by deduct expenses, that means less expenses. We should deduct one by one. So all the expenses posted in the respective inner columns and then we should adding it and then deducted from the respective columns profit. So salaries time ratio 96,000, 36,000, 60,000. General expenses also time ratio 12,000, 4,500, 7,500. Discount on sales, sales ratio. So 40,000, 16,000, 24,000. Advertisement sales ratio. In the previous problems, we should take an advertisement action. They are given rupees 500 per month like this. We should take an action. Here they have given directly adjustment, so it should be allocated on the base of sales ratio. 50,000, 20,000, 30,000. Preliminary expenses post 70,000, 70,000. That means we should post one post incorporation period. Rental rates time ratio 15,000, 5,625, 9,375. Printing and stationery time ratio 65,000, 24,375, 40,625. So we almost post all the expenses. Then we should add all the expenses in total and pre-incorporation, post-incorporation columns respectively. So total expenses 3,48,000. It should be deducted from total income. We will get 7,20,000 as net profit. Then for pre-incorporation expenses 1,06,500 should be deducted from 4,25,500. We will get 3,19,000. That amount is called as pre-incorporation profit or profit prior to incorporation or capital profit. then followed by post incorporation columns. We should add all the expenses related to post incorporation period. That amount is 2,41,500. It should be deducted from 6,42,500. We will get 4,01,000. That amount is called as, or that profit is called as post incorporation profit or revenue profit. So, do you understand the answer posted in the previous question and this question? That means there is no income available in the previous two problems. This problem we have an income. So we should add it with the gross profit and then we should deduct the expenses. We will get net profit, profit prior to incorporation, post incorporation profit. Right? Looks like the next problem also, problem number 8. So X company purchased a business on 1493. The company obtained a certificate of incorporation 31/7/93. The following particulars for the year ended 31/3/94. Ascertain profit prior to incorporation and divisible profits. So total sales up to 31/7/93 10 lakh. Sales from 1493 to 31/7/93 rupees 2,50,000. Then gross profit for the period 2,12,000. The expenses debited to profit and loss account, whereas under. So they are given some expenses: rent, insurance, salaries, selling expenses, advertisement, audit fees, bad debts, rupees 850 related to pre-incorporation. That means the balance amount related to post-incorporation. General expenses, direct fees, preliminary expenses, interest paid to vendor up to 1st September 93. That means we make to some adjustments. Then interest on debentures, printing and stationery, depreciation on machinery, commission on sales. So these are all the expenses given in the profit and loss. So from 14 to 31/7, that period is called as pre-incorporation period. Then 31/7/93 to 31/3/94, that period is called as post-incorporation period. Based on that, we should calculate time ratio and the sales ratio, and also preparation of statement of profit and profit prior to incorporation. So calculation of time ratio. Time ratio equal period after incorporation is the period after incorporation. So 1493 to 31/7/93, 4 months is 31/7/93 to 31/3/94, 8 months. So ratio is 1:2. Calculation of sales ratio. Sales ratio equal to sales up to incorporation is to sales after incorporation. So they are given directly: sales up to incorporation 2,50,000. Total sales for the period is 10 lakhs. We should deduct from the up to incorporation sales 2,50,000. We will get sales after incorporation. So 2,50,000 is 10 lakh minus 2,50,000. We will get 2,50,000 is 7,50,000. So sales ratio is 1:3. So we have one more adjustment: calculation of adjusted time ratio for interest paid to vendor, because we have some adjustment. So here interest paid to vendor up to 1st September 19. So from the opening date to 1st September 19. Okay. For that purpose, we should calculate adjusted time ratio. So from 1493 to 31/7/93 period for period after incorporation. Then east after incorporation to the closing date 31/7/93 to 1993. That means 4 months east, 1 month, because there is no we can't able to take July. We have in between 31 July 93 to 1st October 93. We have in between only 1 month. So 4 months east, 1 month. So ratio is 4:1. This ratio using only for interest paid to vendor, right? Right. So statement of profit prior to incorporation of X Limited for 31/3/94. Particulars basis ratio, total 2 columns, pre-incorporation 2 columns, post-incorporation 2 columns. In this problem, we have only one revenue, that is called as gross profit, followed by expenses. So gross profit allocated on the basis of sales ratio. The total gross profit is 2,12,000, allocated on the basis of 1:3, 53,000, 1,59,000. Then less expenses. Rent time ratio 6,000, 2,000, 4,000. Insurance also time ratio 1,500, 500,000. Salaries also time ratio. So 27,000, 9,000, 18,000. Selling expenses sales ratio 1 is to 9,000, 2,250, 6,750. Today's notes comes under the category of sales ratio, 8,000, 2,000, 6,000. Then audit fees, time ratio, 1,200, 400, 800. Bad debts, actual, because they are given something within the bracket. So total amount is 2,400, out of which 850 related to pre-incorporation. Then the remaining value 1,550 is under post-incorporation period. General expenses, time ratio, 4,800, 1,600, 3,200. Director fees, post 2,600, it should be posted only in post incorporation. Preliminary expenses, it's also allocated on the desktop on the on for post incorporation period only. 7,200 posted directly in post incorporation period. Then interest to vendor adjusted time ratio 4 is to 1. The total interest is 5,000. So allocated on the basis of 4 is to 1. So carefully allocate interest to vendor, generally allocated on the basis of time ratio, but here they have paid up to certain period. They have mentioned in that problem 1st September 93. For that purpose, we calculate adjusted time ratio. The adjusted time ratio is 4 is to 1. So the total amount is 5,000. The 5,000 is allocated on the basis of 4 is to 1. So 4,000, 1,000. Then interest on debentures, post incorporation. If you directly post incorporation, 4,000. Then printing and stationery, time ratio, 4,200, 1,200, 2,800. Then depreciation on machinery, time ratio, 30,000, 10,000, 20,000. Then commission on sales ratio, 12,600, 3,150, 9,450. Then we should add all the expenses in the respective columns, total as well as pre-incorporation and post-incorporation. For total column, the total expenses is 1,22,000, 25,500. It should be deducted from 2,12,000. We will get 86,500. That profit is called as net profit. Then for pre-incorporation period, the total expenses is 37,150. It should be deducted from 53,000. We will get the remaining value 15,850. That profit is called as profit prior to incorporation or pre-incorporation profit. Then we will move to post-incorporation period. The post-incorporation period total expenses is 88,350. It should be deducted from 1,59,000. We will get 70,650. That profit is called as post-incorporation profit. That profit is called as divisible profit. That's it. That's